Hello, everybody. Welcome back to This Week in Housing San Diego, episode number 7. This week, we are lucky enough to be joined by Mr. Nick Richardson with JMJ Financial, one of the top lenders in the county. Nick, how are you today?
I'm doing great, Ryan. Thank you for having me.
Oh, you bet. We're glad to have you here. So, all right, let's get to it today. Big news coming out. So here we go. This is the headline that was early this morning, maybe late last night. May unemployment rate expected to be near 20%. As millions more lose their jobs. Oh my God, we're all going to die. It's horrible. It's terrible. Yeah, not so much. All right, so new non-farm, not confirm. There's your autocorrect for the day. Payroll unemployment rose by 2.5 million in May. The unemployment rate declined from 14.7 to 13.3. U.S. Bureau of Labor Statistics reported today. I'm glad we're getting all the misspellings out of the way on slide 1 today. All right, so here's what we got. Actual unemployment rate, 13.3%. That is absolutely outstanding news. I know Nick's going to talk about this a little bit more. So here are the projections. Goldman Sachs, who has basically been the gold standard we've been using if you've been following the show, they were projecting 21.5. Ratner at 20 plus, calculated risk at 19.7, and the Wall Street Journal at 19.5. Happy to let you all know they were wrong. Very good news for the country. Very good news for everybody. All right, so when we take a look at the unemployment, right, this is an updated graph from last week, and this is really telling a very interesting story. So on the far left, back to March 21st, we were at 3.3 million people had filed for unemployment, 3.1 of which were currently collecting unemployment insurance. Right, so dark blue is filed, light blue collecting. So as we've gone through the pandemic, the forced shutdown, the repression, we can see that people are losing their jobs, right? We've been talking about this. These are real people. The number that you're looking at on the right, 42.5, that's 42.5 million people that don't have a job right now. All right. So we're not trying to make light of this or to play this down in any way. That is 42.5 million people that have had their lives disrupted at a minimum. All right. So the good news about this, we can see that we have largely peaked and are coming back down on the people that are actually collecting the unemployment insurance. So that is 3 straight weeks where we have ticked down. That is absolutely wonderful news there. All right, so this was CNBC this morning. The May gain was by far the biggest one-month jobs surge in U.S. history since at least 1939. That's the Great Depression right there. All right, so taking a look at the jobs, 2.5 million jobs lost. I think just about everybody was expecting to see that number on a negative side, not on the positive side. All right, so when we take a look and dig into the report, 1.4 million of the 2.5, food services, drinks, bars, they're coming back. All right, when we're talking about construction, 464,000 new jobs. Education and health services, 424 people, 424K are back. Retail, that was the one that nobody knew about. That was one that we were always very curious about. How quickly will people feel comfortable going back into the store? Well, 368,000 of us thought it was totally okay. So that's back, right? Working hard there. Other jobs, 272K are back. Manufacturing, 225K, professional services, 127K, right? All wonderful news. What hasn't come back yet? We have all others. Okay, cool. Big category, 77,000. Hotels, still not back, right? We're down 148K. Government jobs, right? So we're talking city, county, state, and federal. We're down 585,000 jobs, right? So what is this telling us? This is telling us that it looks like the economy is without a doubt coming back, and that is wonderful news. We knew that the food and drink was coming back. There was no doubt about that. We knew construction was coming back. There was no doubt about that. Education, those of you that have been at home with kids, you knew they were coming back. Health services, right? Something that not a lot of people have talked about throughout this pandemic. How many hundreds of thousands of Americans are going to die after this is all done because they neglected to go to the physician because they were told they couldn't? How many people with heart attacks just said, hey, I'm not going to the ER. I don't want to die from the coronavirus. How is that going to impact people, right? Those jobs, those healthcare providers are back and they're getting back to work, right? Retail is huge. Government jobs, we'll have to see. And then hotels, again, that's really coming down to how quickly people are going to feel comfortable, A, traveling, and then B, staying at a hotel. So that's something we're just going to have to simply keep an eye on. Looking more in depth at the U.S. Bureau of Labor Statistics report that came out today. Now, keep in mind, this data is only through the middle of May. All right, so this does not account for the last 3 or 4 weeks, okay? So here's what we got. Of the people that were surveyed, of the total number of people, 13% unemployed. That means 87% are employed. Right? A lot of people like to focus on the little 13 right there, and that's not a good number. That's a lot. That's 42.1 million people. On the flip side of that is 87% of the country is still busy getting after it and making it happen for everybody. That number 13, that's going to come down. All right. Now, this next pie graph is very, very telling. All right. This is talking to employers, and they were asked how many of the jobs that you've lost are either temporary or permanent. All right. Now, this graph, if you've been following this over the last 5-6 weeks, that number 81%, that number has decreased. That number used to be a lot closer to 90. Right. At this point, it's down to 81, meaning 81% of the people that no longer are employed right now think that they will be back, or that the employers will bring their employees back. The percentage that think that it is a permanent job loss has now ticked up to 19%. So we're going to have to keep an eye on this as we're going through. But overall, good news. Another continuation of a good trend. All right, so we saw this slide last week, but I felt it's really important to bring it back. So this was looking at the Federal Reserve Bank's May report. 75% of job losses are temporary layoffs or furloughs, according to employers. The results align with news reports of large-scale hirings at firms such as Amazon, Walmart, CVS Healthcare, Domino's Pizza, and others. They are continuing to hire more and more people. All right, so now, this is another version of the larger graph where we were comparing what are we looking at today, what are we projecting into the future compared to past crises, right? So this is now simply looking at the Great Depression. All right, so if we take a look on the far left, in 1932, we were at 23.6% unemployment. We're currently at 13.3. If you turn on MSNBC, it's most certainly going to sound like we're worse off than the Great Depression right now. Here's the real world numbers for you, ladies and gentlemen. All right, 13.3 to 10.6. We have 10% more people employed right now than we did in 1932. In 1933, 24.9. That was the peak. We're projected right now by Goldman Sachs to be at 9% in 2021. In 1934, it went from 25 down to 21.7%. We're projected to be at 7.8. In 1935, 20.1%. We're projected to be at 6.6. Hopefully that is clarifying what is going on today and what the newest, most accurate projections are looking like, and comparing that to what it seems like a whole lot of people are really wanting to compare today to. All right, so that being said, this is Tony Bedekin, head of the global markets with Citizens Bank. Barring a second surge of COVID-19, the overall U.S. economy may have turned the corner, as evidenced by the surprise job gains today, even though it still remains to be seen exactly what the new normal will look like. So there's your economy update. I know, Nick, you have some stuff to bring in, so let me bring in Nick right here. So, Nick, the floor is yours.
Awesome. Well, thanks again for having me. I want to focus, obviously, I'm the mortgage expert on the call, perhaps. So I want to talk about interest rates, right? And surprisingly enough, a lot of my data aligns directly with the economic data or the perceived economic data that you, Ryan, were presenting. In that, when COVID hit, let's say mid-March, the Federal Reserve, lowered their interest rates where banks can borrow from the Fed directly, and everyone, I think that rate went to zero, in fact, and everyone thought that meant that, mortgage rates were going to bottom. So historically, mortgage rates are about 2.25% higher than the money at which the lenders borrow from the Fed, and that's how banks make money. It's the spread on the loan. So, if I can borrow at 0%, Ryan, and charge you 2.25% in a mortgage, that's usually how it works. Well, lenders didn't bring down the interest rates down to 2.25%. They brought them down to about 3.5% at the beginning of COVID because I think there was a lot of uncertainty. And then what happened was there was a huge rush of refinances. I think people were perhaps worried about their job and the continuity of that, so they wanted to reduce their payment, kind of in protection mode. And then secondly, with interest rates so low, it was just a great financial impact to refinance for most people. In my 9 years of doing mortgage, I was locking and have been locking interest rates under 3% for 30-year mortgages, and that's a record for me. So my family members are refinancing, and a lot of people that I've helped buy homes over the years. So if that's a situation you want to look at, obviously call a lender that you know or trust. So along with that, as the stock market dropped and as refinances came into the system, the banks got kind of leery, and then more doom and gloom, Ryan, as you were saying, a lot of media and projections where there's going to be rampant unemployment in years and years, and there would not be a V-shaped rebound of the economy. In fact, there could be devastation. So lenders started increasing the criteria for which you needed to have to qualify for a loan. One of those being your credit score, right? So historically, we've done loans, with credit scores as low as about 580. I saw restrictions, for example, large banks, and don't quote me, but for example, a Citibank or a Wells, I saw one of the major players say that they wouldn't do a loan with under 740 credit score. And then another example of that is a lot of the large lenders turned off their jumbo lending. And in San Diego County, that would be a loan amount over $1,500. So if you're looking to buy, a $2 million home, you would need 1.3 million down payment roughly to get out of that jumbo category, or you wouldn't be able to get a loan. So a lot of programs were shut off, Ryan, like we had talked about. A lot of the loans that were becoming more prevalent before COVID, such as those folks that are self-employed, I could get bank statements and do some creative financing. Those loans went away from us early on. Those were canceled and said, no investor wants to buy this loan right now. So from my seat in my chair and my experience, my logical thought was these guys are concerned the housing market's going to take a tumble. But what the real world that I've seen is that housing is more of a supply and demand equation, and there's not a lot of homes available in the market. So I'm still seeing multiple offers. My clients that are trying to buy homes are having to compete at all price levels, from $400,000 to $1.5 million in San Diego. And it seems to me that the housing market's very healthy, very strong. One other thing that I thought we could touch on, what are the impacts of getting a loan or buying a home during COVID-19 or while shelter in place was intact? One of the big challenges in the industry of lending is the appraisal. So normally an appraiser is going to enter your home or the home you're about to buy and look at the condition of the home and take measurements and verify a number of things and do inspections. That wasn't occurring. So Fannie Mae and Freddie Mac allowed us to do appraisal waivers. So for example, if you're putting 20% down, we would run the financial scenario through the computer, and Fannie Mae oftentimes waived the need for an appraisal. And then another option they gave us was to do a drive-by appraisal. So, they took some liberties and said you didn't have to go inside necessarily. You could just look at the title records or perhaps the MLS information that a great realtor like Ryan Riell would provide, and make your calculation that way. So another component of lending is you've got to sign your loan documents, and that's a pretty official process. When you sign your name on a 30-year note, you're taking your fingerprints and 2 forms of ID and you're signing your life away for a while, right? So with social distancing and those things, those processes have been ironed out. I know that oftentimes a notary will sit, across a long table and you kind of ask questions from afar, and I've not seen any hiccups or hurdles with anything like that as well. Kind of flipping to a different topic is Ryan had asked that I talk about what is the difference between getting pre-approved for a loan versus pre-qualified for a loan. So I like to say that if I met you, Ryan, at a Starbucks this afternoon. I don't even know if they're open or not, but we'd have our masks on, I'm sure. But I could ask you a few quick questions, such as, tell me about your income, tell me about your debts, tell me how much down payment you have, and I could do a quick calculation and tell you, oh, I think you qualify for roughly, just pick a number, 500,000. So that's pre-qualification. It doesn't really mean anything. It's just, you've spoken to someone and this is what they think. This is their professional opinion, if you will. A pre-approval, alternatively, is much more official process. I call it a pre-underwrite. So in my business, you meet with someone like me and we exchange paperwork, but ultimately the underwriter checks and balances, looks at your paperwork, and finally approves your loan. In the pre-approval process, I'm taking all of your paperwork. I am pulling your credit. I'm taking your tax returns, your W-2s, your pay stubs, and I am pre-underwriting the file and running your file through some software we have with Fannie Mae, and we get a preliminary approval called desktop underwriting. DU approve eligible is the term we use in the industry. So to get pre-approved, I'm going to pull your credit. It entails a hard inquiry on your credit report. Everyone always asks me, will this hurt my credit? I have not in 9 years seen anyone's credit score go down from a mortgage inquiry. Now, that's not what you read on the web. And I would also say that, if you went and got 3 consumer credit cards today, your credit score could go down. But if you got 3 mortgage inquiries today, I would argue there'd be no impact. So I am going to pre-approve you, pull your credit. It does not cost you any money. You're not committed to the lender with whom you're pre-approved. Obviously, you want to give them a chance to win your loan, but you can still have the option of shopping around at any time. And that usually occurs when you're in contract on the home, because I have clients ask me, should I shop for an interest rate right now, Ryan? And I say, well, it's kind of like buying gas for your car. Is your tank empty and are you near a gas station? You buy then. In the housing world, when you have a contract in hand, when your realtors helped you find a home and negotiated a fair price and the seller and the buyer have signed the contract, that's when a lender can lock your interest rate. Make sense? So that's kind of the content I had today, Ryan. Did you have any direct questions for me? If not,
I do.
You're up, my friend.
I do. I have a couple. Okay, first question. Let's say we have a buyer looking at $1 million home, and let's, for math simplicity, the county conforming limit, let's make it 700 instead of 7015 or whatever it is.
Right.
So let's say that they come to you, hey, we want to buy $1 million home. The increased down payment that's required now with the jumbo and the credit scores, the down payment is the 20 or 25% that would be required. Is that based off the difference between the purchase price and the county conforming limit? Or is that the entire loan because it's over the county conforming?
Yes, it's based off the purchase price. So in your example, $1 million home, you'd normally need $200,000 to meet the 20% down requirement. In our example, you would need $300,000 to get it to that $700,000, rounded number limit that we used.
Okay, so the $300,000 to go on top of the $700,000 to get to the $1 million. So the $300,000. That's the amount of the loan that we would need the down payment on?
Nope. I'm sorry. We would give you a loan for $700,000. You would need $300,000 of your own money to buy that house. Mm-hmm. Your down payment.
Okay. And then if they wanted to do a jumbo to get up to the $1 million purchase price.
Yes.
How does that change it?
So I was given an example earlier that some of the large banks had turned off, at least suspended their jumbo lending. As some of these numbers have come back that you gave on your presentation, and as lenders have gotten financial data and feel more comfortable, I believe these programs could come back this afternoon, for example, but very soon, right? Because I'm seeing things come back to normal as we open up. And a few weeks ago, we didn't even know how many governors were going to say, the state's open across the country. So the lending world, I would say, in the last 10 business days or so has drastically turned, just like kind of the data is turning. And, if there is another outbreak or we get bad news, I expect we could be turbulent in my industry again and rates could move. It's been a crazy time, as we all know.
Mm-hmm. Very sure. Very true. All right. Second question. So then for the people that are out there that pre-COVID had been pre-approved for a loan over the county conforming limit, let's say $1 million or more in the Carmel Valley area or Del Mar,
Yes.
how many of them are you seeing, well, I guess a percentage, that now due to the changed restrictions for getting a loan, higher credit, higher down payment, et cetera, the tightening up of the jumbos, what percentage of those buyers are no longer qualified?
That's a good question. If I had to take a guess, because in my personal, with my personal clients that are shopping, I just, may have had some good luck. They're still employed and they can still get a loan. So, but it's a very valid concern. And I've just been, again, probably lucky with the statistics breakdown there. But in general, I would guess probably the same percentage of people that are unemployed in the economy. And I will tell you that in San Diego, if you're working as a service worker or at a restaurant and a lot of your money's cash perhaps, and you don't report a lot of money, you're probably not going to qualify for a traditional loan anyway, with the prices being so high. So I would say as a lender, you didn't see that impact as much. The higher income earners who were laid off, obviously that's an impact. They would not qualify for a loan. This is an interesting point that I should have brought up earlier. This was a big change that impacted a few of my clients. A lot of, with the CARES Act that came out pretty early in the COVID, situation, you could ask your lender to defer or have forbearance for roughly 3 months of your mortgage payments. Well, a lot of folks who perhaps didn't need to, they had their job, nothing changed financially, but it was a convenient, yes, I should do that because I'm going to, instead of paying my mortgage, I'm going to save those 3 months in case this thing gets worse. So absolutely great thing to consider, great thing to do perhaps based on your situation. The downside though is that kind of was the exact time that the lenders started tightening up, because the last thing, if you think how lenders make money, we underwrite you get in your house, and then you make your first payment roughly 30 days later, and we start making money on the interest, and the money, the interest payments start coming in. So when the CARES Act came out, the lenders, the financial community said, we could originate these loans, but yet miss our first 3 payments, and we're not making any money. So that's why a lot of the credit tightening occurred. Currently, as it stands today, if you have requested forbearance or deferral or any, let's call it, help me with my mortgage program, I can't give you a loan. I can't. You are done for the next year. If you're late, if you miss a payment, I can't give you a loan, no matter if you're a gazillionaire with perfect credit score and you like me and I like you. I can't do it. Those are just the rules. So one thing I would recommend is, if you're going to explore forbearance or deferral or help me in my mortgage program, weigh those components. If you're thinking about buying in the next year, perhaps, you would postpone that opportunity or not do it at all because you have other interests at hand. Then, I need a 3-month buffer. So that's a big thing that I've seen in the industry from COVID, kind of something. Those were the rules before, but lenders have never offered that program. So I didn't expect for then the folks that took advantage of that program to be slapped on the wrist so hard. And basically you're disqualified for a year in buying any property. So that could change. Maybe Fannie Mae will come out with different guidelines, after things improve, but those are kind of the rules right now.
We can see if we can get old Dodd and Frank back out of retirement. So
there you go.
All right. That was my next question, was about the CARES Act. I got one more for you. What are you seeing in terms on your end? What are you actually seeing on the ground, and what are you seeing forecasted or projected in terms of distressed properties, pre-foreclosures, notice of default, short sales, et cetera?
Perfect. It's funny because there's a saying in our industry that equity cures all, right? So I've been in the business, like I said, 9 years. So 2011 was after the 2008 crash and after Dodd-Frank, and after this industry became heavily regulated. But my point is, since that time, Ryan, all I've ever seen is a nice increase in home appreciation, right? So if I ever had a client that lost their job or, had financial difficulties for any reason and couldn't make their mortgage payment, they didn't call me. They called you. They sold their home because they had, they were going to make money if they sold their home. They weren't going to turn that home over to the lender for a short sale or foreclosure or, a loan modification, if you will. So I kind of like that because I haven't had to see the tough side of lending. Right now, I haven't seen any short sales, any pre-foreclosures, nothing. However, I think that could be due to the fact that these 3-month help me with my mortgage programs are currently in place. And, still there's a large number of people that lost their jobs. So I would think that would have to flow through the economy somehow. Those folks are going to struggle to maintain their home, or perhaps they may want to sell to get out from under it because home prices are still really strong. So I think it'll loosen up the inventory, if I had to guess, a little bit. But then in our market specifically, we have a supply and demand problem. So if you really think about it, if one person's unfortunate enough to lose their house, where are they going to go? They're going to try and have to rent, right? Because they won't qualify for a mortgage. Hopefully they have some income or a place to go. They're going to have to rent a home. And then someone's going to jump in their home. And there's still only a limited supply and too many people for the supply that we have. So I think that keeps the price pressure. I think your industry is predicting an increase in the housing, and you and I have had this conversation with clients for years now. What happens when the economy turns? What happens when the stock market crashes? And you probably said this before, that doesn't mean that home prices drop. It's not always correlated. It's not always linear. So it's tough to predict. These are unprecedented times. I tell people that, I would definitely think about it before I bought a home, but then I also tell them in the same breath, you wouldn't be the only person buying a home right now. I can promise you that, because my phone is ringing. My realtor friends are busy, and escrows are closing. That's what I'm seeing in San Diego.
Yeah. It ties into what we've been talking about for a while. And you, I think, hit the main point that I've been hitting is I think CoreLogic came out with a report at the beginning of the year that the average mortgage in the U.S. had $177K worth of equity.
Right.
So that leading into 2008 and 2008 and 9, the issue was a lot of homeowners were upside down. And so you had some that simply were like, hey, we can't afford this. And that surged the inventory, and that started part of that. That was contributing to the process. And then ultimately, when they were underwater or upside down, that's where all the distressed properties came into play. With today, if we added 5% to what we lost, so we lost 20% in the housing market in 2008. So if we went to 25% down, losing 25% tomorrow, that 177K goes down to 125 to 135K. People aren't walking away from that. They're going to do exactly what you said, and what a lot of people did in leading into and in 2008 and 9 was, I'm going to sell the property. I'm not going to hand this over to the bank. So I think if we do end up seeing homeowners running into a lot of trouble if this continues, I think that you're simply just going to see homeowners cashing out. They're going to put their home on the market. They're going to take their 125K and they're going to take their ball and go home. And they'll go find a new home. They'll rent. They'll do whatever they're going to need to do. So I don't think we're going to see a tremendous amount of the distressed properties. But what will be interesting is, and you had brought this up kind of tangentially, when those people sell their homes, they're now going to have to turn around and go find a replacement. So maybe they're fortunate enough to be able to buy another property. Maybe they are in a position where they have to go rent, right? And so the rental properties or investment properties, especially here in San Diego, is going to be something to keep an eye on, because there have, in general, Airbnb and VRBO and all that have fallen off the face of the earth right now. So you have a lot of homeowners, a lot of investment property owners that can't rent their place out. And so if they own it outright, whatever. It's a loss of income. They're not going to lose the property. But if they are having to make a mortgage payment on this and they are counting on that short-term rental income to pay that, that's a place where we could see distressed properties. I don't think we're going to see distressed anything. I think we're going to see people simply unloading them. So I think that could lead to a surge in inventory, which would be wonderful in light of the fact that we're still tremendously low inventory-wise here in San Diego anyways. Have you seen anything moving around with the investment properties?
I haven't. I didn't talk about a few of the lending restrictions with investment properties, but it used to be pre-COVID. Speaking of equity, let's just assume you bought your investment property in 1970. This was grandpa's home, for example, and it's appreciated up to $1 million. Kind of a normal home in San Diego. Unfortunately, they're pretty expensive. But maybe your mortgage is $100,000. You would normally pre-COVID be able to come to a lender and say, hey, Nick, I want to pull out a couple $100,000 out of my investment property. It's got a ton of equity. I'm a great candidate, great credit. You love me. Give me my loan, please. Of course, happy to do that, make that transaction. Now, some of the restrictions are it's very difficult to pull cash out, that equity that you've talked about, to pull cash out of an investment property. You can still do it out of your primary residence, but not an investment property. So that's a little bit of a loan restriction. And my take on it is, some of the investors, again, are a little bit nervous. I don't want my clients who have equity in their home pulling it all out and going, I always joke to, cross the border to Tijuana and gone forever kind of thing. Run across the border, get away, take your money and run. Yeah. So that's something with investment properties I've seen. Otherwise, people are still lending. Normally you need about 25% down at least for a rental property to make sense in San Diego, because rental incomes are high, but prices are high and need some down payment to make that thing cash flow usually, unless Ryan finds you a gem.
I did find one yesterday. One of my clients found one, and then it was gone.
Yes, an hour. Shocking.
Very happy about that. But yeah.
But kind of to your, what I thought of when you're talking about, and I hope, I'm not saying I want this to happen, but let's say, unfortunately, there might be some foreclosures or short sales or people that can't afford their homes, they put on the market. San Diego is a heavy investment community. These shows, Fix Up Your House or Fix It or Flip It, or all the stuff my wife makes me watch that I try and tune out of once in a while because I work in the industry. I get tired every once in a while. People invest here. It's a climate. You can be outdoors and work on your house 12 months out of the year, not 7 in Minneapolis. So I think investors would be poised to jump on those homes, and therefore you might not see the drop in prices that you might expect.
Yeah. There's nothing we're seeing. We'll get into this here in a minute with the on the ground numbers, but the pricing did come down about $12,000 off the median from last month, but we're going to dig into that and explain it. But that pricing we're not seeing pricing coming back. I think that what we saw was a blip, and I'll explain that here in a second. It'll be interesting to see. I think, you were talking about the equity that people have and not being able to pull it out. That was another one of the two resounding differences between today and leading into 2008 was, I think, leading in the 3 years leading into 2000, call it 6, 7, 8, somewhere in that ballpark, Americans had withdrawn $832 billion worth of their equity. Today, we're at 230 something. So I think a lot of American homeowners learned their lesson that if you're going to use your house to finance your lifestyle, you're going to be up a creek without a paddle if something bad happens. So we'll have to see. All right, well, let's go to the real estate, the on-the-ground stuff. Here we go. All right, so we do have the new June data. It being 5 days in, this is pretty stabilized. So let's go ahead and get to it here. So the median sales price, it did drop. It was at 600. We're now at 587, 745. That is a 2.2% increase from May of 2019, right? So remember, we are in June. The data we're looking at is from the month of May. Obviously, we haven't been through June yet. So in terms of the year over year, we are up 2.2% compared to where we were last month. We're at 587, 745. Why? Right? So we are looking, when we look at a sales price, right, that also could be sold, meaning past tense. It's already taken place. So the normal escrow here in San Diego, 30 days, maybe up to 45, somewhere in there. So anything that we saw close in the month of May means it either entered escrow somewhere in the month of April. If it wasn't April, it was in March. Right? And if everybody can remember back that far, what the heck was going on come March 19th, we had this little shutdown thing go on here, right? So the numbers we're looking at, the sold properties that's generating that median sales price, these were properties that sold in the middle of this pandemic, all right? So do we expect to see the pricing come down a little bit? I'm not shocked. I figured it would be somewhere between probably 590 and maybe 605. It ended up being a little bit under 590. All right. So that's what we're looking at for median sales price. Median days on market, 11 days. That's up from, I believe it was 8 days last month. So we have 3 additional days for people to consider looking at a property. That is 21% less than what we were at a year ago in the month of May. When we look at months worth of inventory, we ticked up by 0.1 months or 1.9 months worth of inventory. That is 30% lower across the county than we were last year at this time. All right. So some perspective for you. Nationally speaking, if we have somewhere between 6 and 7 months worth of inventory, it's a stable market. If we have 7 months or more, it's considered to be a buyer's market. 4 months or less is considered to be a seller's market. In San Diego, if we had 4 months worth of inventory, that would be the end all be all of buyer markets in the last 5 to 10 years, and everybody would be happy. We have been well under 2 for quite a while, and depending on the specific zip codes, it can get under 1 month. All right, so just is not a lot of homes available to purchase. All right, so when we look at the number of active listings throughout the month of May, we're at 5,059. 34% less than a year ago. All right, so lower number of homes for sale. New listings. These are next two are going to be the big numbers we want to look at. New listings in the month of May. All right, so keep in mind in May, there were a handful of states that had said, hey, we're open. Thank you. We're good. All right, there were a bunch of other states that were like, no, we're good. We're going to stay closed. All right, so as we entered into May, even California started to loosen up, San Diego County in particular, and a lot more states as we moved through May started to open up. All right, so looking at the new listings, year over year, we're down 25%. But if we take a look at where the coronavirus came into play, it really started to become prevalent across the country, in the news at least, in the late February, beginning of March. We get to the middle of March and we full on shut down. All right. So looking at this, that number 3908, that is 25% less than it was a year ago. But if we roll that backwards and say, what is it comparable to? Those are the numbers that we traditionally see in February, year over year over year over year. All right, so let's take a look at the pendings and let's see if this gives us anything. So 3127, right? That means those are homes that were on the market, offer accepted, into escrow. That's roughly 8% less than a year ago, right? But if we take a look at the numbers, roll them back and say, what is this comparable to? These are normal numbers in February and March, right? So what does all of this mean? It more than likely means that we're in the middle of the spring market right now. So traditionally in March, that's when things start heating up. We get into April and May, and it is full on craziness here with sales, all right? Obviously, in April and May, it wasn't full on crazy. The numbers are in front of you. You can see them. All right. But if we say, hey, what does this compare to? The summer is the new spring. That's where we are. All right. So you want to know what? Those of you that are watching this, you have the same advantage that I've been telling all of my clients. You ready? 95+% of your competition that's out there has no freaking clue what's going on. They're watching whatever they're seeing on the news, that if it's national, at best it's 60 days old, probably closer to 90. If it's local, it's at least 30 days old, more than likely 60, probably even closer to 90. All right. So those of you that are getting this information right here, the market's back, ladies and gentlemen. It is back. And the buyers that are out there that are aware of this, they're the ones that are making it happen. And they're not having the competition, the bidding wars necessarily. And as you said, Nick, the bidding wars are coming back without a doubt. We're starting to see more and more of everything. up to a couple $1 million getting multiple offers on stuff, right? So it's really, the buyers are there. The buyers are 100% there. And if you've been listening or watching this over the last couple of weeks, you've seen the data. I don't have it on this week's show, but the buyers are absolutely out looking. There's just nothing to buy here in San Diego. So the last data point is also going to tie back into the first one, the number of sold listings, 1842. That is 42% less than a year ago. All right, we roll that back. We're again into the February-March timeframe. But keep in mind, these were homes that had to be shown to potential buyers. They had to accept an offer in the middle of the pandemic. Right? We're talking about this happening in April, where there was a tremendous amount of uncertainty, a tremendous amount of fear, and a whole bunch of just craziness going on. All right. So what we're seeing in terms of what's going on the ground in San Diego, the real estate market's back. If you're looking to buy, now is going to be the time to do that. Because if you wait another couple of weeks, people are going to start figuring this out. And instead of having 2 or 3 or 4 offers on a property, you're going to start to see 5, 10, 15, 20 offers on a property. Don't believe me? Stand by. You're going to get some. All right. So here's a quote. This was from last week, but I still feel it is a very, very important quote. This is from Mark Fleming with the First American. He's the chief economist. Monthly data that looks back 3 to 4 weeks is old news. All right. The data we just went through is verifying that again. All right. We know from the faster moving data, mortgage applications, showings, bidding wars, that April really was the trough, I think, for the housing market. The existing home sale numbers select that now, but we do not expect the rebound to be quite strong in the May numbers that will come out at the end of June. All right, so we're going to have to see what the numbers are coming out with. But in general, the market is looking like it's back. All right, so here's the bottom line in terms of real estate, and you guys have been hearing this for the last couple of weeks. If you are a homeowner and you've had any thoughts of moving up or moving down, now is the time to have that conversation with the real estate agent, with the realtor, with the trusted advisor. There are buyers upon buyers upon buyers. I have 15 to 20 buyers that are like airplanes waiting to land at an airport. They just need a house to buy. All right. And I know that there are some of my colleagues in the office, same thing. Talking with some of the other top agents around the county, same thing. There's just nothing available for sale. You're ready to cash out? You're ready to get the equity out and downsize? You want to take your equity and upsize? Now is the time to do it. We can sell your property in record time and get you your cash out. Buyers, if you're standing on the sidelines right now, you are going to have more competition coming. You're going to have more offers, bidding wars, less time to evaluate a property and make a decision. So if you've had thoughts of selling, pick up the phone. My contact info will be up here shortly. If you've had thoughts of buying, pick up the phone. Get in line, because there are a tremendous number of buyers. You want me to move you to the front of that line? You want me to make things happen for you? We can do that. And one of the key parts of this is Nick, who's on the call with us, obviously. One of the top lenders in the county. When I send buyers to Nick, he makes stuff happen. And that is, at the end of the day, oh, it's 0.01% higher on a loan. Did you get the loan? Was it approved? Are you now living in your house? That's what we're trying to do here at the end of the day, guys. So, all right, here's everybody's contact info. Nick on the right, me on the left. Let's go ahead and stop the screen sharing. We'll pop all that back up for people to take a peek. Nick, bring you back in. Do you have anything that you want to add? Any stuff along those lines from what I was showing, or anything in general that you want to add?
Yeah, I've got a question for you. Let's assume I'm a buyer and I'm fully pre-approved and ready to go, and you and I have agreed to work together, and I want you to show me property. What happens if I get into a property and we're in escrow and I'm doing all the right things from my perspective, but I do lose my job? Am I financially responsible for the deposit that I put in, or how does that work during COVID-19? Is there any thing that would make me more comfortable?
Great question. Great question. All right, couple different things with that. So we obviously have the different contingency periods. So if you're under the inspection contingency, cancel, no factor. If we're still under the loan contingency and that has an impact on the ability to qualify, no factor, loan contingency, cancel, you're done. During the coronavirus, there is a new addendum that the California Association of Realtors created, the CBA Coronavirus Advisory or Addendum. Basically, if you can show that the coronavirus pandemic has impacted you in any way, shape, or form, that's free pass to get out of jail.
Okay, so even, God forbid, I had a loved one or my spouse who's on the loan, my income earner is, sickened by the COVID disease or the flu.
Yeah,
I'm okay?
If somebody that is involved in the purchase comes down with the coronavirus, that is automatic. There's zero questions asked about the CVA. Send it in, cancel out, you're good.
Okay.
If you lose your job due to something else, then you're going to have to talk with
you'd have your loan escape with, your lost job there, right?
Yeah. There's multiple exit routes, whether it be inspection or whether it be the loan contingency or whether it just be the CVA.
Okay.
But yeah, that's what they put it in place for. They basically have codified that it is a force majeure, an act of God. So it's something that's out of everybody's control.
Okay. Thank you.
Yeah, you bet. All right, guys. Well, we're going to be running out of time right now. We didn't have time to get to any questions, so we're going to go ahead and end this. Nick, is there anything else you wanted to add?
No, thanks for having me. Very informative. I appreciate you educating me today, Mr. Riell. Thank you.
Well, thank you, Mr. Richardson. All right, everybody. Thanks for joining in. We'll get this up on YouTube shortly, and we'll chop it up also. So, all right, everybody. Thank you much, and we will catch you all later.